Hello, International Finance students. In this brief lecture, we'll talk a little bit about forecasting exchange rates. So, naturally, you can think about if you're an industrial firm that transacts internationally, you would be interested, or you would love to be able to know if the currency in which you're transacting is going to change. If its exchange rate is going to change, and if so, by how much and when. Right, that would be wonderful to know. This is not always easy, right? It's usually very difficult or close to impossible. Precisely because these exchanges depend on so many things, right? You have expected future inflation. You have the relative, all of those, right? The purchasing power parity relationships depend on shipping costs and capital controls and, difficulty of manufacturing things and, all sorts of things, right? So, there's lots and lots and lots of things that go into exchange rates, and even simple things you wouldn't think of, work differently than you. So, right, the U.S. might cut its interest rate, and you would think that would lead to weaker currency, but it matters what's going on globally, right? So if everyone else is also cutting rates, and we cut rates less than they cut rates, then our currency, then the dollar will look relatively more attractive and strengthen. Or, there's chaos or concern about, structural disruption in the global economy. And then people buy dollars because it's safe, even if the returns are bad. And so an increase of safety demand can lead to a relative strengthening of the dollar. So there's just so much there, right? So your text describes three main approaches to thinking about forecasting exchange rates. And so I'll, describe each, briefly. So the first is the efficient market hypothesis, and that is basically stating pretty much that that the prices that things are trading in the marketplace currently is the price that accurately represents all of the information relevant to that security. Right? That information relevant to the security gets incorporated. So that would mean people, right? A bunch of people doing a bunch of research have discovered a lot of truths about the world, and they use those truths to model stock prices, and they accurately model, prices. And if the official market hypothesis holds, then prices only change when there's new information. Right? Pretty much. And so that's kind of important, right? Because that would be in contrast to an assumption that the efficient market hypothesis doesn't hold in the currency market. And that would mean that prices are set by some other process or a combination of the two, and that you don't really know what has happened or what will happen. Or that these prices are based on other things like, market manipulation or, sentiment or whatever it is. Right? So, we have the random walk hypothesis, which just suggests that basically the best predictor of tomorrow's exchange rate is today's exchange rate. We know it will drift. It'll change. Some days it's up, some days it's down, but that basically the best prediction is of tomorrow is today. And this isn't so sophisticated currency exchange rate forecasting models are tend to be not too different from what we just described. So they usually start from a presumption that things will be the same, but then it might add but it does kind of a little bit tend to draft towards this particular level, right? And so you say, okay, well, so this can be in a model where it's like, well, it's a random walk, but it's a random walk with a little bit of bias towards, a particular exchange rate. Like, so I think about with the yen in Japan, it seems like it's always hovering somewhere around 100 yen to the dollar. Now, that's very, very wrong right now. And maybe the days of 100 yen to the dollar are over. That, again, it would depend on like all the things we talk about affecting exchange rates and relative exchange rates. But in general, compared to lots of other things you could do, assuming that your future exchange rate will just be your current exchange rate is, pretty efficient, and among all the things you can do, not terribly inaccurate, because these things do have a lot of inertia. But, sometimes, governments institute policies that affect exchange rates directly. Think about, the U.S. and China had the trade war thing going that affected their, currency exchange rate. But yeah, so the efficient market approach, though, is to, basically operate under the assumption that lots of people have done the good work of getting information into currencies. And so, if you're buying a currency, the thing that's going to make that a bad choice is, some revelation of unknown stuff, or a change in the fundamental change in the world or the way it operates. That efficient approach means you don't really have to do anything, because you can just trust that other people have incorporated all the information, and you just take prices as given. The fundamental approach is different, right? It doesn't try to assume that exchange rates are just naturally, follow some particular approach. So this fundamental approach, that's where you're looking at the exchange rate over time and then trying to do statistical analysis using other data to figure out where it's going. This is really hard. We'll look at some studies that, that show this isn't generally very effective, although there's exceptions. And a big part of this, right, is you have all these data that you would use to do this, but then now that means often you have to predict that data, right? So if you can say, oh yeah, the U.S. exchange rate with China depends a on how the American soybean harvest does. It's like, okay, great. If that's true, then now all we have to do is predict the soybean harvest. And that's, basically as difficult as predicting the exchange rates, really, right? So it doesn't necessarily get you anywhere, because the things that you need are hard to forecast. But it's, comforting to think it might be possible. So some challenges that the book talks about are, right, you've got these, you do a model and then you use the model to make predictions, but that model is based on the world as it was when the model was made. And sometimes, the world can change enough that the model doesn't work anymore in, pretty short order. So they get old quickly. They can be wrong themselves, or you can have a wrong model and then it doesn't work very well. So, the fundamental approach, especially from the perspective of currencies, is pretty challenging. Right? You're kind of say, okay, treat the country like a business, and then think about, how well managed the currency is relative to the last time you checked, right? So, this is difficult, but people do it. And then the last we'll talk about is technical approach. So a technical approach basically assumes that market efficiency is violated. So, prices can move in predictable ways, and if you just figure out the pattern, you can profit by just, trading the pattern. And the idea is that history repeats itself, right? Like a certain sort of scenario of transactions or price exchange values is accurate, and so then that it comes up again. These can be kind of goofy, right? Because you're looking for these patterns to indicate where you are, and that's not dependent on any fundamental truth about the countries in question or anything. It's just sort of looking at the picture and making statements. But it can be true that a particular pattern showing up in the exchange rate might be symptomatic of some larger, systemic issue that does significantly affect exchange rates that maybe was not, on the radar of leadership before then, right? So we'll look at a couple just quick examples of those. So here we have two moving averages. We have a long-term moving average and a short-term moving average. So the idea is this is really momentum trading. So you're saying, okay, well, when the currency is weak or has been getting weaker, but is now getting stronger. So the long-term average is still trending down, but the short-term average is trending up, and we cross, right? The expected exchange rate crosses a boundary, right? Where it's say, okay, the short-term one used to predict exchange rates that were really low. Now the short-term predicts exchange rates that are high, and that would lead to, purchase decisions, right? So if you're, a family that owns a bunch of, American goods, if they're just holding cash, they might want to turn in their cash and buy whatever currency this is, and then, undo that later if it changes the way it looks, right? If we get to the short-term average crashing through the long-term average boundary, that's a bad sign. So I guess it's sort of like, what this is implicitly saying is if the currency is increasing in value, and it has been increasing in value for a long time and is still increasing in value in the short term, that's not going to necessarily justify some kind of trade. Because, right, a lot of times we expect these exchange rates to change by a reliable amount every year, right? If we have, right, from, this is covered interest arbitrage, right? If you have these different interest rates, then the exchange rates should move predictably. And so that's, not very interesting, but where the short-term rate is climbing when the long-term rate is falling and the short-term rate passes the long-term rate, this is sort of an indication like, okay, well, we were down in the dumps and now we've turned a corner, and that can be a strong indication that things are going up in the short term. So it's the crossover rule. So the golden cross is short crosses over from being below the long-term average to above the long-term average. And then the death's cross is the short-term average crosses from being above the long-term average to being below the short-term average. Okay, now we have a head and shoulders pattern. So there's tons of these little patterns that people like ascribe to or look at. But again, we're if you're looking at a random walk where it just moves up or down or straight at any given like little moment, you get like sort of, you get a thing that looks like a stock chart where it's sort of, jaggedy and moves up and down kind of randomly. And so, there's a claim that when you see this kind of pattern, right, when it goes up and then down a little bit and then up and then down and then up a little bit and then down, that this will then be up and then down, right? So if you own this currency, you were on the right shoulder, you would want to sell, right? So you sort of, the idea is you watch for these patterns, and then when you spot them, then you do the transaction that it says that it makes sense to do. So you'll get a chance to do something like this in the technical trading assignment. So what I have is a set of 4 different simulated currencies. This is just like listed A, B, C, D. So I've got 4 currencies, and you'll implement a trading strategy in Excel to try to forecast the exchange rates. You'll sort of say, okay, I will, when I get this when I have a head and shoulders thing, right, when it goes up, down, up, I'm going to assume after that is down, right? And then you'll see how often you're right. And so we'll use if-then statements to count. Anyway, point being, this is, you can implementing technical trading patterns is pretty easy to just test them if they're working. They almost never work, but, there can be exceptions to that. So we've got these tools, right? We've got efficient markets, fundamental and technical. So how does it turn out? Well, the research on it is interesting and kind of mixed in the sense that for the most part, it doesn't really appear that exchange rates are very predictable. So there are sort of exceptional exceptions that seem to be able to do well, especially for long-term predictions. So you have all this short-term noise that's hard to make sense of, but then you get these longer trends, and there are definitely some sophisticated parties that seem to be able to do this a little bit, but on average, mostly it doesn't work, right? That's Yoon and Semmerhall. The second paper here, this reinforces that professionals have a hard time predicting exchange rates. Like it's just hard, right? It looks mostly like random noise, and any kind of fundamental or technical analysis doesn't seem to be very effective unless you're very, very sophisticated. And partly because there's so many things that goes into exchange rates that are also themselves very difficult to predict, right? I mean, predicting recessions is like notoriously very difficult to do. So forecasting performance using some of these models, according to this, this last paper, is it's more effective. It works better for developed countries than developing countries, right? So if you have a more established, mature economy, your exchange rates tend to be a little bit more, I don't know, scrutable. Is that a word? Like, is it legible? That, it's still difficult and doesn't work very well, but you'll have a better chance of making decent exchange rate predictions on a developed country's currency than on a developing currency. Yep. So that's it for forecasting. We just touched on a few things, we'll get a chance to try it a little bit in the project.